Today's Talk About It Tuesday question is, please discuss taking life insurance policies and putting it into a trust for cash value to use as collateral for larger investments. Is it worth doing despite what you taught us about why whole life is not a valuable investment? Putting a whole life insurance policy into a trust is very different from term life because whole life has cash value, ownership rights, and tax consequences. Done right, it can be powerful. Done wrong, it can create taxes and headaches. Is this true? All right, let me break this into two parts. So I want to finally maybe put this whole thing to bed about any value whatsoever to having a whole life insurance policy. Now, notice the questioner said, despite what you have taught us, because I've done several videos on the difference between whole life and term life and why whole life is not an investment, period, and not even a good value. But maybe I left out some key things that will finally make it make sense why I not feel this way, why I know this to be a fact. Okay, so I don't care what your best friend, your cousin who sells, or the person on your job who is an insurance agent, I don't care what they tell you about it being a good idea for you. It is not. It is a good idea for them for you to get a whole life policy because they do not get paid commissions on term life policies, and the insurance companies don't make extra money on term life policies. There are extremely high commissions that motivate insurance agents to sell it to you. Every time you make a premium, make a payment, they get paid a commission for it for years, as long as you have the policy. So they are incentivized to sell you something that's going to put money in their pocket. They are not doing it for you because a death benefit is a death benefit. If there's a $100,000 term life policy, the death payout is $100,000. If it's a whole life policy, the payout is $100,000. The difference is what you pay every single month. You will pay 2 to 3, sometimes 4 times as much for a whole life policy as you will a term life policy for the exact same payout if you die. So they try to appeal to your greed and ignorance by saying, but it has cash value when you have a whole life policy, and a term life policy doesn't have cash value. And you're saying, oh, cash value, what does that mean? Well, you can borrow against a whole life policy, and it's like not borrowing from a bank, it's borrowing from yourself. Okay, so now let me explain that, because for some bizarre reason, it's not so bizarre. I get it, right? Because they skip over some of the details. People think if they have $1 million death benefit, that the moment they buy this policy and they start paying their premiums, they can borrow $1 million. You cannot. You cannot borrow against the total death benefit. You borrow against the cash value it accumulates over time, which is a tiny fraction of the death benefit. And listen to this. Let me make this clear. You will not accumulate any. Zero. You will have no cash value in the first 5 years of that policy. So you're paying, again, 2 to 3 times the amount you would for a term life policy. And in the first 5 years, there is no cash value to borrow against. In the first 10 years, the amount of cash value is negligible. And so it is not even worth borrowing against it because it will be such a tiny loan, you could probably get more credit on your credit card. It takes 15, really 20 years before the cash value is substantial enough to be worth borrowing against. So that means you've paid 2 to 3 to 4 times more premium for the same death benefit for 20 years to borrow against your policy, and your policy is the collateral for the loan. It is not interest free. So you're not really borrowing from yourself. You're taking from your own, you're taking the money collateralized by your death benefit, and you're paying 6 to 8%. Currently, it's about 6 to 8% interest on the loan. The only difference is they don't do a credit check because they already have the collateral. They don't care. They're going to get the money whether you live or die, one way or another. So you're paying 2 to 3 times more for a death benefit you could get for 2 to 3 times less for something you can't borrow against that makes sense until 20 years down the road. That makes no sense. I don't care if you put it in a trust. And let me just put this whole trust thing to bed. 99% of people have no use for a trust. It will present no meaningful benefit for you to have a trust. A trust is a means to transfer wealth. It is a means to hide wealth. It can be a means of asset protection. But most of you don't need it because there are other avenues that are less tedious, less time intense, less labor intense, less of a hassle to use. You do not need a trust. So people are just enamored with these words that are not in their common vernacular. And they say, well, rich people have a trust. You don't need a trust. You don't need a trust. Putting a life insurance policy in a trust doesn't make sense for 99.9% of people. And there's no use for you to do cash value, whole life, universal index life, any of these things that you can borrow against because there are other means for you to borrow money to leverage for an investment. And that's what the question asked. Is it a good idea to use it to leverage it for another investment? If you have other assets, if you took that same money and invested it yourself in an index fund for 20 years, you could borrow against your index fund. If your credit is decent, you can borrow money anyway. If you have a home, you can borrow against your home. There are so many other ways to borrow that don't require you to pay 2 to 3 times more than you need to for a death benefit. It makes no sense. So I hope this puts the nail in the coffin for you. Look at my other videos on whole life insurance. It is one of the biggest ripoffs in American history. One of the biggest ripoffs, one of the biggest wastes of money, one of the biggest scams, one of the biggest hustles, one of the worst ways you could spend your money. Period. Period. I don't know how many times and how many ways to say it. So to answer the question, no, it is not a good strategy. No, it's not a good use of your money. No, it's not a good use of your money's time. No, it's not a good way to try to gain leverage for another investment. No, you pay 2-3 times way too much for 20 years to borrow against a death benefit. That makes no sense. 0 cents. So hopefully that finally answers that question. Hopefully, if I get the question again, I'll keep answering it until it makes sense. But as the questioner said, I've said this a million times before in a million different ways in a million different videos. So I'd like to hear your thoughts on it, though. Maybe you have some counterpoint that makes sense that I'm missing that I just can't see, but I doubt it. But I'd love to hear your thoughts. Keep the questions coming, and I'll see you next Tuesday.